Ladies and gentlemen, something is happening in the precious metals market that most investors are not prepared for. Silver is sending signals, loud, volatile, and impossible to ignore. Gold is tightening its grip, and the entire system is beginning to show pressure points that have been building for years. This is not just another market update, this is a warning phase. Stay focused because what follows could redefine the way you think about wealth preservation and opportunity in metals. Silver does not move in isolation, and what we are witnessing right now is not just a price fluctuation or a temporary speculative wave, but a deeper structural tension building beneath the surface of the global metals market that has been forming for years through cycles of suppression, industrial expansion, monetary uncertainty, and investor psychology shifting in ways that most market participants are not fully appreciating yet. Because when silver begins to enter what can only be described as a critical breakout pressure zone, it is rarely about the immediate chart alone and far more about the underlying imbalance between physical availability and paper representation, between real-world demand and financialized abstraction, and between long-term accumulation and short-term speculation that creates a kind of invisible compression that eventually resolves in sudden and often violent repricing events that historically catch the majority off guard. What makes this phase particularly significant is not just that silver is rising or testing resistance levels, but that the conditions surrounding it are aligning in a way that resembles earlier inflection periods, where supply elasticity begins to fail under expanding demand vectors, especially from industrial sectors that are no longer marginal contributors but dominant forces in consumption, including solar technology expansion, semiconductor integration, electric mobility systems, and advanced electronics manufacturing, all of which depend on silver's unique conductive properties that cannot be easily substituted without efficiency loss. And when such demand becomes structurally embedded into global manufacturing pipelines, it stops behaving like discretionary demand and starts behaving like baseline requirement demand, meaning even during economic slowdown phases, the pull on physical supply does not fully recede, which creates a persistent upward pressure on inventory drawdowns that most investors only notice when shortages begin to surface in pricing spreads and delivery premiums rather than headline spot prices alone. At the same time, gold's behavior in this environment cannot be ignored because gold is not just moving as a parallel asset, but as a signal of macro level uncertainty, acting as a monetary barometer that reflects central bank behavior, currency stability concerns, and long-duration capital hedging strategies. And when gold begins to tighten into consolidation while maintaining elevated structural support levels, it often indicates that large holders are repositioning rather than exiting, absorbing volatility rather than distributing supply. And this phase of tightening ranges is often what precedes larger directional expansion, especially when real interest rate expectations begin to shift or when geopolitical risk premiums re-enter valuation models in a more sustained way rather than short-lived reactions that fade quickly. The critical point investors tend to miss in silver cycles is that silver behaves as both a monetary metal and an industrial commodity. But unlike gold, its above-ground stock is significantly more consumed over time rather than stored, meaning every industrial cycle effectively removes a portion of silver from potential monetary circulation permanently, and this creates a compounding scarcity effect that does not reset easily, especially when recycling rates fail to keep pace with consumption growth. And this imbalance is not theoretical but measurable in the widening gap between mine supply growth and end-use demand expansion over multi-year horizons, which gradually reduces the system's ability to respond to demand shocks without price dislocation. When we refer to a critical breakout pressure zone, what is really being described is a convergence of technical compression and fundamental strain, where price action appears contained within a range on charts, yet underneath that range liquidity conditions are becoming increasingly fragile, volatility is being suppressed temporarily through positioning dynamics, and open interest structures are becoming more one-sided, which historically leads to sharp repricing events when catalysts emerge, whether those catalysts are macroeconomic shifts, policy changes, industrial demand surprises, or even simple inventory revelations that expose how tight physical markets have become relative to perceived availability. One of the most overlooked dimensions in this environment is the growing divergence between paper silver markets and physical silver markets, where futures pricing and derivative structures may suggest stability or controlled movement, while physical premiums in retail and wholesale channels begin to expand, indicating that actual deliverable supply is under stress. And this divergence is often one of the earliest warning signs that the market is transitioning from a liquidity abundant regime into a liquidity constrained regime, where the marginal price is no longer set by speculative positioning but by physical acquisition urgency. And that shift tends to accelerate rapidly once confidence in continuous availability begins to erode. Investor behavior also plays a crucial role in this phase, because silver attracts a unique mix of participants ranging from long-term monetary hedge buyers to short-term momentum traders. And when sentiment begins to tilt toward anticipation of breakout conditions, positioning becomes crowded on both sides, creating a coiled structure where stop levels accumulate above resistance zones and below support levels, effectively storing liquidity that can be triggered once price escapes its containment structure. And in such environments, movement is rarely gradual, instead unfolding in bursts that redefine prior valuation assumptions within compressed time frames. Gold's consolidation during this period acts almost like a stabilizing anchor in the broader precious metals complex, suggesting that large institutional participants are not rotating out of the sector, but rather balancing exposure while waiting for macro confirmation signals. And this is often seen in environments where central bank demand remains structurally supportive, sovereign accumulation continues quietly in the background, and currency debasement concerns are not being resolved but rather deferred, leading to a situation where gold holds elevated levels without aggressive retracement, building a foundation that supports eventual upward continuation. If macro conditions align, inflation dynamics further complicate the picture, because even when headline inflation appears to moderate, underlying structural inflation in energy, labor, and supply chain reconfiguration costs continues to persist in many sectors. And precious metals historically respond not just to inflation levels, but to inflation uncertainty, meaning the inability of policy frameworks to fully stabilize long-term purchasing power expectations creates a tailwind for monetary hedges. And silver, due to its dual nature, often experiences amplified response during such phases once momentum transitions from accumulation to expansion. The key insight in this entire setup is that silver does not require widespread public participation to move significantly. In fact, many of the most powerful silver movements in history have begun with relatively low public awareness and limited retail engagement, followed by institutional repositioning and physical market tightening that forces repricing before mainstream attention fully arrives. And this lag between underlying structural change and public recognition is where the most asymmetric opportunity tends to exist, but also where most hesitation occurs, because the early phases do not always present obvious confirmation signals in conventional financial media narratives. What is unfolding now resembles a market that is coiling under multiple layers of constraint, where industrial demand is steady and expanding, monetary uncertainty remains unresolved, physical supply chains are tightening gradually, and speculative positioning is accumulating in a way that creates sensitivity to triggers rather than stability. And when markets reach this state, the concept of resistance levels becomes less about technical barriers and more about psychological thresholds that, once breached, lead to rapid reassessment of value across the entire participant base. There is also an important structural consideration regarding mining supply responsiveness, because unlike financial assets that can be increased in circulation quickly, silver mining output is constrained by geological, capital expenditure, and regulatory timelines, meaning supply cannot respond quickly enough to sudden demand increases. And even when prices rise, the lag effect in bringing new production online creates a window where scarcity conditions intensify rather than resolve, which is counterintuitive for participants expecting immediate equilibrium restoration. As these dynamics continue to build, the pressure zone becomes less of a chart pattern and more of a reflection of systemic imbalance, where the longer price remains compressed under expanding fundamental stress, the more energy accumulates for eventual repricing, and in such environments, the transition point often arrives not gradually but abruptly, triggered by relatively minor catalysts that would otherwise appear insignificant in stable market conditions, yet in a compressed system act as release mechanisms for pent-up movement that has been developing over extended periods. The broader implication for investors observing this environment is that traditional linear thinking about price movement becomes less effective because silver in these phases behaves less like a stable trend asset and more like a spring under tension, where time itself becomes a factor in how energy is stored within the market structure. And the longer the compression persists without resolution, the more pronounced the eventual expansion tends to be, not necessarily in a single direction without retracement, but in a revaluation process that challenges prior assumptions about fair value ranges. And within this evolving landscape, the key question is not simply whether silver will move, but how the interplay between physical demand, monetary uncertainty, and speculative positioning will resolve once the current equilibrium can no longer hold under incremental pressure, especially as global macro conditions continue to shift in ways that are not always immediately reflected in surface-level pricing behavior, leaving the underlying structure in a state of ongoing tension that continues to build without clear indication of how or when the release phase will fully begin. Gold is not behaving like a typical speculative asset in this phase of the market cycle. And what appears on the surface as a simple consolidation pattern is actually something far more structurally significant, because when gold tightens into a sustained range after an extended period of macro-driven repricing, it is often reflecting a deeper equilibrium process between central bank accumulation, institutional hedging flows, currency confidence adjustments, and long-duration capital repositioning that does not show up in retail sentiment until much later. And this is where most observers misread the situation by focusing on short-term price movement instead of understanding the underlying compression of volatility that signals preparation for a larger directional expansion phase. What is particularly important right now is that gold is not falling apart despite repeated macro uncertainty cycles, and that resilience itself is a signal, because in past market regimes, when gold was not supported by structural demand, it would typically experience sharp retracements when real yields rose or when the dollar strengthened. Yet in the current environment, those reactions are increasingly muted, suggesting that there is a persistent bid underneath the market that is absorbing supply during dips rather than allowing price discovery to reset meaningfully lower. And that persistent bid is not driven by short-term speculation but by strategic allocation decisions that are tied to long-term monetary hedging frameworks, sovereign reserve diversification, and systemic risk management strategies that operate independently of day-to-day market sentiment. This consolidation phase is not random, and it is not merely technical resistance being tested repeatedly, but rather a manifestation of competing forces reaching temporary balance, where upside pressure from inflation uncertainty, geopolitical fragmentation, and de-dollarization trends is being met by cyclical macro forces such as interest rate expectations, liquidity tightening in certain credit channels, and portfolio rebalancing activity that temporarily slows momentum without reversing the underlying structural trend, creating a compressed range that often precedes larger moves once one side of the equilibrium begins to dominate decisively. Another critical dimension in this environment is the behavior of central banks, which has fundamentally altered the long-term demand structure for gold, because unlike previous decades where central bank participation was relatively passive or even net negative in some periods, recent cycles have shown sustained accumulation behavior, and that accumulation is not price sensitive in the traditional sense, meaning that dips are often met with continued purchasing rather than hesitation, and this removes a significant source of downside elasticity from the market, effectively creating a floor that is not visible in traditional technical analysis, but becomes evident over time as retracements become shallower and recoveries become faster. At the same time, the role of real interest rates is becoming more complex, because nominal rate adjustments no longer translate into the same real yield impact they once did due to persistent inflation volatility and structural fiscal expansion across major economies. And this disconnect between policy rates and real purchasing power stability reduces the effectiveness of traditional monetary tightening as a suppressor of gold demand, meaning that even in environments where interest rates are elevated, gold continues to find support because the opportunity cost calculation is distorted by uncertainty in inflation persistence rather than clarity in inflation control. Gold is also functioning increasingly as a geopolitical risk barometer, and this role has become more pronounced as global economic fragmentation increases, trade realignments accelerate, and reserve diversification strategies gain momentum among emerging economies. And in such a context, gold is not merely an investment asset, but a strategic reserve instrument that carries implications far beyond portfolio allocation because it represents a non-sovereign, non-liability based store of value that is not dependent on counterparty trust. And in periods where trust in financial systems becomes uneven across regions, demand for such assets naturally becomes more resilient and less sensitive to short-term price fluctuations. The consolidation range itself is significant because it represents a digestion phase of prior gains, where market participants are recalibrating expectations about fair value in an environment where historical correlations are breaking down. And during such phases, volatility contracts not because interest in the asset is declining, but because disagreement about direction temporarily stabilizes as participants wait for new macro catalysts to define the next dominant narrative. And this waiting period often creates the illusion of stagnation when in reality it is a period of accumulation and repositioning at multiple levels of the market structure. It is also important to recognize that gold's liquidity profile is different from most financial assets because a significant portion of supply is held in long-term storage, central bank reserves, or investment products that are not actively traded on a daily basis, which means that marginal flows have a disproportionate impact on price discovery. And when new demand enters the system during periods of tight float availability, price adjustments can occur more rapidly than expected because there is less freely circulating supply available to absorb incremental buying pressure without repricing. In addition, the psychological component of gold consolidation cannot be ignored because markets often move through phases of expectation adjustment where participants initially become frustrated by lack of immediate continuation, then begin to doubt the sustainability of prior trends, and eventually reposition only after confirmation signals appear. But by the time such signals are widely recognized, much of the initial movement has already occurred, and this behavioral lag creates a recurring pattern where gold appears to move slowly for extended periods and then accelerates sharply once sentiment alignment reaches a tipping point. The macro backdrop supporting gold remains structurally complex rather than simple, because while certain indicators such as nominal growth or employment data may suggest stability, underlying fiscal pressures, debt accumulation trends, and long-term currency debasement concerns continue to evolve in the background, and gold tends to respond more strongly to these long-term structural dynamics than to short-term cyclical fluctuations, meaning that even when surface-level data appears stable, the underlying drivers of gold demand may still be strengthening gradually without immediate reflection in price acceleration. Another key factor is liquidity distribution across global financial systems, because in environments where liquidity is unevenly distributed, with certain sectors experiencing tightening while others remain relatively abundant, gold often acts as a bridge asset that absorbs excess uncertainty capital. And this function becomes more important when confidence in traditional yield-bearing instruments is challenged by volatility in credit markets or by uncertainty in long-term fiscal sustainability, leading to gradual but persistent inflows that support consolidation rather than breakdown. What makes this phase particularly interesting is that gold is maintaining elevated levels while absorbing repeated macro shocks without significant structural damage. And this resilience suggests that the market is in a state of controlled balance rather than exhaustion, meaning that participants are not exiting en masse, but are instead rotating, reallocating, and waiting for confirmation of broader macro direction before committing to larger directional positioning, and this kind of behavior typically precedes expansion phases rather than contraction phases. There is also a growing divergence between paper positioning and physical accumulation trends, where derivative markets may show fluctuations in sentiment while physical demand from institutional and sovereign actors continues to build quietly, and this divergence often creates conditions where surface level indicators fail to capture underlying accumulation pressure, leading to underestimation of how tight actual available supply may become if demand accelerates even modestly from current levels. The consolidation is also reinforced by global currency dynamics because when multiple fiat currencies are simultaneously experiencing varying degrees of weakness or instability relative to each other, gold becomes a neutral reference asset that is not dependent on any single currency system, and this increases its attractiveness during periods of relative currency uncertainty rather than absolute crisis alone.